Welcome to WealthWise, your ultimate guide to smart investing and financial independence. Ready to level up your financial game? Let's dive in. In our last video, we delved into the basics of investing and wealth creation. We explored the importance of investing as a key to financial independence. We discussed the power of compound interest and how time in the market can significantly multiply your wealth. We also touched on the different investment vehicles available, from stocks and bonds to mutual funds and ETFs, and how each one plays a unique role in a balanced portfolio. We also addressed the importance of having a clear financial goal and matching your investment strategies to those goals. We highlighted the value of and the discipline to stay the course, even when the market gets a little bumpy. And most importantly, we underscored the significance of financial education in making informed decisions. Now we're ready to take our financial journey to the next level with advanced investment strategies. Before we start, please don't forget to smash that like button. If you found this video helpful, subscribe to our channel for more financial wisdom and leave your thoughts in the comments below. We value your feedback and look forward to hearing from you. Our first advanced strategy centers around an approach called dollar cost averaging. You'd be wondering, what exactly is this strategy? It's a straightforward yet highly effective method intended to optimize investment returns over time. The core principle of dollar cost averaging is to invest a fixed sum at regular intervals, regardless of the market's fluctuating nature. It's comparable to putting your investments on autopilot. This implies you end up buying more shares during price drops and fewer shares when prices escalate, which eventually leads to reduced average cost per share over a long period. Yes, it's as simple as that. The appeal of dollar cost averaging lies in its ability to smooth out market volatility. We all know how unpredictable markets can be, swinging back and forth like a pendulum. But with dollar cost averaging, you eliminate the need to time the market or make forecasts. Instead, you can just relax and watch your investments grow over time. Not sure what it means for you? Let's dive into some real-life examples. Imagine two investors, Alice and Bob. Alice tries to time the market, making lump sum investments when she thinks the price is low. Bob, on the other hand, employs dollar cost averaging, investing a fixed amount every month. Over time, Bob's average cost per share tends to be more economical than Alice's, all due to the wonders of dollar cost averaging. It suggests that Bob possibly gains more returns on his investments. Are you wondering how you can effectively implement this strategy? It requires a systematic approach. First, decide on the investment amount and frequency. This could amount every week, month, or quarter. Consistency is the key here. Next, choose your investment. This could be anything from stocks, bonds, mutual funds, or any other asset type, depending on your financial goals and risk tolerance. Note that diversification forms the foundation of risk management. Finally, stick to your plan. Yes, the market will fluctuate. Yes, there may be times when you're tempted to stray from your plan. But remember, dollar cost averaging is a long-term strategy. It's about weathering the storm, not avoiding it. What if the market changes? What if your financial goals evolve? That's when monitoring and adjustments play a part. Keep an eye on your investments, review your strategy periodically, and make necessary adjustments. Perhaps you want to invest more or less, or change your investment frequency, or perhaps you want to reallocate your assets. The is yours. Remember, the goal of dollar cost averaging is not to guarantee profits or prevent losses. It's about risk management, reducing market volatility, and potentially increasing your returns in the long run. It's about taking emotions out of investment decisions and making your money work smarter, not harder. So there you have it, the power of dollar cost averaging. A simple yet impactful strategy that can help you enhance your returns and grow your wealth. But remember, like any investment strategy, it requires patience, discipline, and a long term. Remember, regular investing intervals can help you weather the storm of market. Why not give dollar cost averaging a try? The journey to financial independence is not a sprint, but a marathon. With the right strategies, you can cross the finish line with a sense of accomplishment. Next, we delve into the effective methods to increase wealth efficiently, with due consideration to, in the complex world of investing, what truly counts isn't just your earnings, but the amount that remains with you post-taxation. Here is where astute tax-savvy wealth-building strategies become crucial. These tactics can contribute to enhancing your post-tax returns and fast-track your wealth aggregation. we initiate with tax-friendly accounts. These unique kinds of investment accounts proffer tax benefits for the investors. Some of the most prevalent ones include individual retirement accounts, IRAs, 401(k)s, and health savings accounts, HSAs. IRAs, to illustrate, are of two main kinds, traditional and Roth. Traditional IRAs provide a tax deduction on contributions in the year they are made, but withdrawals post-retirement are taxed as ordinary income. Roth IRAs, contrastingly, are funded with post-tax dollars, but withdrawals post-retirement are entirely tax-exempt. 401(k)s function similarly to traditional IRAs, offering a tax deduction on contributions and taxing withdrawals post-retirement. Simultaneously, HSAs are triple tax-friendly, contributions are tax-deductible, growth is tax-exempt, and withdrawals for qualified medical expenditures are also tax-exempt. Each of these accounts carries its own set of rules and limitations, but the commonality is that they all offer ways to either defer or entirely evade paying taxes on your investments, leading to significantly increased wealth accumulation over an extended period. Now, we move on to tax loss harvesting. This is a tactic that involves selling investments that have depreciated to counterbalance gains from other investments. The objective is to curtail your tax liability by balancing your gains and losses. For instance, suppose you sold some stocks this year, making a profit of $10,000, but you also hold some stocks that have depreciated by $5,000. By selling these depreciating stocks, you can counterbalance half of your gains and reduce your tax payment. Keep in mind, though, tax loss harvesting is a fairly sophisticated strategy that requires meticulous consideration and planning. It's not a task to be undertaken impulsively, and it's always advisable to consult with a tax expert before executing this strategy. Next up are dividend reinvestment plans, or DRIPs. These plans permit investors to automatically reinvest their dividends back into more shares of the same stock or fund, often without any transaction charges. This can be a potent tool for accumulating your investment returns over time. What's more, since the reinvested dividends buy more shares that can generate their own dividends, this can initiate a virtuous cycle of growth. The icing on the cake? If the DRIP is held in a tax-advantaged account, all of this can transpire without triggering any immediate tax liabilities. To illustrate the effectiveness of these tax-intelligent strategies, let's study a case. Consider two investors, Alice and Bob. Both begin with the same amount of capital, invest in the same assets, and earn the same returns. But Alice uses a tax-advantaged account, practices tax loss harvesting, and uses a DRIP, while Bob refrains from these practices. After a span of 30 years, Alice accumulates significantly more money than Bob, even though they commenced at the same point. The differentiation? Alice's tax-intelligent strategies enabled her to retain more of her returns and compound her wealth more efficiently. To summarize, tax-intelligent wealth build-up strategies can offer significant benefits for investors. By leveraging tax-advantaged accounts, executing tax loss harvesting where suitable, and employing DRIPs, you can enhance your post-tax returns and fast-track your wealth build-up. Remember, it's not just about your earnings, but the amount that stays with you. And with these tax-intelligent strategies, more of your hard-earned money can stay where it truly belongs, in your pocket. With these tax-intelligent strategies, you can enhance your post-tax returns and fast-track your wealth build-up. Don't log off just yet. Stay tuned till the end for more valuable insights that will amplify your wealth management skills. Finally, we dive into risk management techniques that can protect your investment portfolio. Risk management, as we know, is a critical component of any successful investment strategy. It's the safety net that protects you from financial peril and ensures your portfolio can weather any storm. So, let's delve into some advanced techniques that can enhance your portfolio's resilience and fortify your wealth journey. Firstly, let's talk about asset allocation. This is the practice of spreading investments across various asset classes such as stocks, bonds, and cash equivalents. This strategy is built on the principle that different asset classes perform differently under varying market conditions. By distributing your investments, you can cushion your portfolio against market volatility and reduce potential losses. It's a bit like not putting all your eggs in one basket. Instead, you're spreading them out. So if one basket falls, not all your eggs are broken. Asset allocation should align with your financial goals, risk tolerance, and investment horizon. For example, if you're a young investor saving for retirement, you might be more inclined towards a higher equity allocation due to their potential for higher returns over the long term. But if you're nearing retirement, you might prefer a larger portion of bonds for their predictable income and lower risk. Next, we move on to diversification strategies. Diversification is essentially a more granular form of asset allocation. It involves spreading your investments not only across different asset classes, but also within each asset class. For instance, within the equity portion of your portfolio, you might hold stocks from different sectors, industries, and geographical locations. This way, you're less likely to suffer significant losses if one particular sector or market takes a hit. Now let's explore hedging techniques. Hedging is like buying insurance for your portfolio. It involves using financial instruments such as options and futures to offset potential losses from other investments. For example, if you hold a large position in a particular stock, you might buy a put option, which gives you the right to sell the stock at a predetermined price. If the stock's price plunges, your put option will increase in value, offsetting some or all of the loss from the stock. Hedging can be complex and isn't suitable for all investors. But for those with the knowledge and willingness to take on the extra risk, it can be a powerful tool for managing portfolio risk. Next up is assessing risk tolerance. This is a personal and often introspective process. It involves understanding your ability and willingness to lose some or all of your investment in exchange for potential returns. Your risk tolerance can be influenced by factors such as your age, financial situation, investment goals, and even your personality. Remember, it's crucial to align your investment strategy with your risk tolerance. If you're risk-averse, a portfolio heavy on equities might keep you awake at night. Conversely, if you're comfortable taking on more risk for the potential of higher returns, a portfolio dominated by bonds might not satisfy your growth aspirations. Lastly, let's talk about developing a risk management plan. This is a comprehensive strategy that outlines how you'll handle risk in your investment portfolio. It includes setting your risk tolerance, defining your asset allocation strategy, identifying potential risks, and outlining how you'll mitigate these risks. Your risk management plan should be dynamic. It should evolve with changes in your life circumstances, financial goals, and market conditions. Regularly reviewing and adjusting your risk management plan can help keep your investment strategy on track and aligned with your overall financial objectives. By incorporating these advanced risk management techniques, you can protect your investments and ensure steady growth. As the saying goes, it's not about timing the market, but time in the market. And with a solid risk management plan in place, you can confidently stay invested, riding out the market's ups and downs and growing your wealth over the long term. Today, we've traversed through an informative landscape, covering topics from dollar cost averaging to tax-smart strategies and risk management techniques. These advanced investment strategies are the keys to accelerating your growth in wealth and propelling you ever closer to financial independence. The goal is to make your money work smarter, not just harder. Applying these strategies to your financial planning can be a true way to build your wealth. Always keep in mind, the journey to financial independence is akin to a marathon, not a sprint. To continue supporting and benefiting from our content, don't forget to hit the like button, subscribe, and activate the notification bell for any upcoming content. Also, sharing is caring, so feel free to share videos and drop a comment to join the conversation. Stay tuned to WealthWise for more insights to aid you on your financial journey.